Yesterday, something happened in the global markets that confused a lot of investors. Oil price suddenly crossed $100 per barrel because of Iran-Israel war, but just hours later, oil price crashed sharply. Now, here is what really shocked people. Nothing dramatic change in the actual oil supply during those few hours. So, how can prices move this violently? And most importantly, if oil becomes this volatile, what does it mean for markets, inflation, and investors like us? That's an excellent question because oil is not just another commodity, it is one of the most powerful drivers of the global economy. When oil prices move suddenly, the effect ripples through inflation, interest rate, currencies, and stock market. By the end of this video, we will understand why oil suddenly crossed $100, why it crashed shortly after, and why investors around the world watch the oil prices during war. Once you understand the mechanism, you will realize that oil markets often signal economic stress before the stock markets do. To understand the spike, we first need to understand how oil markets react to geopolitical conflict. Whenever tensions escalate in the Middle East, traders immediately fear supply disruption. The reason is simple. A huge portion of world's oil production comes from that region. But even more important is a narrow shipping route called as the Strait of Hormuz. Roughly one-fifth of global oil shipments pass through this route. If this route is disrupted due to war, global energy supply would suddenly shrink. And that fear alone was enough to send the oil prices surging. But the spike did not last very long. After the initial panic, markets started receiving signals that the conflict might not escalate further. When traders believe the worst case scenario is less likely, they begin reversing their positions. And because commodity markets are dominated by large institutional traders, when they start closing positions at the same time, price moves can be extremely sharp. But the real story here is not just about the oil price rising or falling, it's about what oil volatility means for the global economy. Oil sits at the center of modern economic activity. When oil prices rise sharply, transportation becomes more expensive, manufacturing cost increases, food price rise, and inflation accelerates. That is why central banks and investors pay so much attention to the oil price. And once inflation expectations change, financial markets begin reacting almost immediately. When oil prices rise sharply, investors begin asking some important questions. When will the inflation increase again? Will central banks delay the interest rate cuts? Will economic growth slow down? Those questions affect how investors allocate the money across the stocks, bonds, and commodities. And that is why oil markets often react before stock markets do. For investors, the key question right now is not just whether oil rises or falls today. The real question is, will this conflict disrupt the global energy supply? If tensions escalate and shipping routes become risky, oil prices could spike again. But if tensions ease, markets may stabilize. So when you see oil crossing $100 and then crashing shortly after, remember that markets are not reacting to what has already happened, they are reacting to what might happen next. If you want to understand how global events like wars, inflation, and oil prices impact the market, subscribe to the channel because we break down the macro forces that move the money across the world.